Hello traders, welcome back to the channel. This is the fourth video on this technical analysis premium course. In our previous video, we spoke about identifying bullish and bearish pressure on the candles or candlestick patterns. In this video, let's take a closer look at these small extensions you see on the candlesticks. We call them wicks, and some people call them shadows. They can appear on either one or both sides, and they play an important role in these charts. They tell us a story, and they are as important as the candle bodies when it comes to reading and analyzing of the live market. Sometimes you'll see long wicks like this, and other times they'll be shorter than usual. So what do they actually mean for us? These wicks reflect the real competition happening in the market, the ongoing battle between buyers and sellers, particularly around major price levels. First, I will show you how a wick is getting formed before we go towards more technical explanation. Because if you are a new trader, you might find it easier to understand with this kind of clear video. Let's go to gold chart. This happened around a few days ago. If you look at this level, that is an important price zone on 15 minutes chart. If we go back a little bit, price action has respected this level as a support at here and here, then broken that level and it respected again as a resistance over here. Again, price went past that level and it got respected as a support here. Now, the price is getting closer to that level again, and let's see what will happen. Now you can see sellers managed to bring the price all the way down to $4,034 while breaking this level. The time is 2:19 p.m. and this is a 15 minutes candle. Let's play the video again. I stopped it here. Now, time is 2:20, and you can see buyers are fighting hard to bring the price up again, and they managed to bring it up from 4,034 to almost 4,050 within just 1 minute. Okay, let's play it again. Now that 15 minutes candle is already done, and look at this massive extension that happened because of that fight from buyers and sellers around this area. Eventually, buyers managed to bring the price upward in a massive pip count of nearly $20. And also, the price got reversed from that level. That is, the competition happened on that candle, and these extensions tell us the strength of that fight happened behind the scenes. We can see small wicks and longer wicks at different places. If the wick is much longer than usual, it means both buyers and sellers have reacted strongly at that level. Now, let me tell you this before going to the detailed explanation. Trading is a business. If you decide to get into the trading, you need to know what is actually happening behind the scenes. You need to consider this as a business, and you need to think as a businessman. Why am I telling you that? Up to this point, most people talk about trading in terms of what might happen or what they believe will happen. They talk about the probabilities rather than what can certainly happen. But if you truly understand what happens behind the market, you can see the reality of this business and protect yourself from unnecessary losses. You can take 100% confirmed confident trading decisions based on live reading of the price action. Businessmen never risk their money. The reason you blindly believe the people in social media, because you don't know most of the hidden secrets happening behind here. Once you understand the mechanics of order execution and the actions market makers take behind the scenes, you'll realize that it's possible to trade strategically and avoid losing money. So, if you've been struggling in trading so far, don't worry. You can turn yourself into a profitable trader. You just need to study carefully and truly understand how the market works. Okay, let's get back to the topic. If you take a candlestick chart from anywhere, whether it is crypto, commodities, or any other financial market, you can find wicks on most of the candles, maybe on both sides of the candle, or maybe on a single side. But psychology over here is, we don't really care about all the wicks we can see on these charts. The wicks that matter the most to us are the ones that form around important levels, such as supports, resistance, Fibonacci, pivot points, daily weekly highs, lows, etc., etc. Example, if we take this same chart, this wick here is important because it created on a proven support level. These wicks are important because they were created on top of a massive imbalance created in this candle. Since we are already here at this point, I will explain you how this imbalance is getting created. Normally, there are a lot of stop losses placed under candles like this. One of the purposes of this candle is to hunt those stop losses. So market makers pulled out a massive amount sell trades on this candle to bring the price downwards up to this level. That will result in creating large imbalances here, and those has to be filled at some point. So they bought the price back here to file up those imbalances. And look at those wicks created one after another. A very clear sign of filling out their imbalances, and after that price got reversed. When you see wicks are getting created on this kind of market imbalances, there is a possibility that market can reverse. This is a bit of an extra knowledge, but if you don't understand about imbalances, I will do a whole separate video on that, and don't worry about it. We already spoke about how we can identify the trend on our previous videos, and we know what will happen when buyers and sellers start losing their control in these markets. In other words, we know how to identify the candlesticks patterns when they lose their bullish and bearish pressure. All right, let's dig a little deeper into wicks now. Look at this drawing. We can say buyers have control over here, creating these candles with good long bodies. Then gradually, buyers are losing the power when it reaches the resistance zone here. Remember, what is important for us are the wicks which create around the important levels and zones. When the price action reaches this resistance zone, we can see that sellers are entering the market and trying to push the price down. Look at this candle, sellers trying to bring the value down. But still, buyers are powerful. On the next candle, more sellers are getting in and created this longer wick than the previous one, but still buyers managed to push the price up. When the price enters the resistance zone, that's where the real fight starts. You can see buyers tried their best to bring the price up, but sellers have managed to give a nice fight by creating these two long wicks up here. This is a good sign for a possible reversal pattern. Buyers and sellers fought aggressively around this area. Look at this candle. This is an important point we need to understand. Buyers were not able to break the top of the previous candle, and it ended up creating a small, bearish candle. What does this little wick on both sides mean to us? Buyers still had a little fight by trying to push the price here, but sellers won the game. Sellers got the control now, and they managed to bring the price down. So all the way up to here, until the price reaches this support zone, we can see that sellers got the control of the market. If you watched my previous videos, you know how to analyze this pattern when it comes to this area. When it reaches to the support zone, the bodies of the candlesticks gradually become smaller, showing us that sellers losing their interest and control. The other important sign we can see is the wicks are getting created from here, which shows us the presence of buyers again. They gradually started their fight when it reaches to the support zone. Look at this wick here. It is longer than the previous one, which reveals that they managed to push the price up more than on this last candle. Then, on the next candle, sellers managed to bring the price in the resistance zone, but buyers pushed the price back again. Then this last candle, which made inside the support zone, It nearly reached the low of the previous candle, but didn't even manage to pass it, and buyers managed to bring the price up again. We call this a hammer candlestick, or a hammer in the short term. It is a special type of candlestick we can find in all of these financial markets. I will do a separate video on all these special candlestick types and make sure you watch all of them. So this long wick of this hammer shows us the battle between buyers and sellers. Buyers managed to push the price upwards. It reveals us the possibility that market could reverse from that point. You need to understand how to read these patterns clearly. But the most important thing to remember is these price action patterns don't have a fixed structure for them. They don't behave the same way every time. Reversing the price after a wick doesn't mean that it will reverse it the next time. So understand this thoroughly. The presence of wicks at major levels does not guarantee a reversal. The market doesn't move just because a wick appears. It is just creating a possibility of reversal. Let's say everybody go there and long the market with massive lot sizes. I have seen people say price would go up when more buy trades come into the market. No, that's where most of the people get wrong. If everybody go long here, what will happen to the market makers? They will have to pay massive amounts of profits to those long trades, and they might end up shutting their markets down. Think about our general psychology. We all are waiting for such an occasion to long the market or short the market. Just ask yourself, don't we wait for those kinds of chances? That is what these so-called trading gurus taught you. Remember the failure rate of ours. It's 95%. If the market behaves according to the long and short trades of ours, then this market is a holy grail. No, it doesn't work that way. When more people long here, they might make a long candle or two, but they will turn the market down again to hunt the people who bought there. That is how this market behaves. If people go long here with small lot sizes like 0.01 or 0.02, then they don't even care. But when we play with massive lot sizes, the market will feel it. The behavior of these markets, which candle it's going to create in the next 5 minutes, depends on how much money would come to the market during this next 5 minutes. We never know who is putting what kind of lot sizes into this market during next few seconds. Not even the market makers know about it. But algorithm which runs these markets always reacts to the orders coming out from us. This is advanced knowledge, and I'll prove you these things in future with examples. Now, we are discussing the basic theories behind the technical analysis, so I'm not going that deep into the market-making discussions here, but try to understand the real nature behind these markets. There is no future in front of us if we don't understand what is really happening behind the scenes. This is the psychology behind this, and try to learn how to read the market. Another example, this is the British pound US dollar chart 5 minutes time frame. There was a support zone around this area. Look at this massive sell pressure candle without any wicks at all, followed by candles gradually having smaller bodies with wicks. What does it tell us? It shows us the presence of buyers. Then the price got reversed. So what's the key takeaway from this? Wicks, or shadows, represent the ongoing battle between buyers and sellers. While wicks appear on most candles, the ones that form around significant price levels carry more meaning. They can indicate a potential trend reversal or signal that the market may enter a consolidation phase. So if somebody asks me whether we can use wicks for trading, I would say yes, but not as a standalone signal. We might use wicks with other confirmations to make trade decisions, but I will cover them in my future videos. Me personally, do not trade wicks at key levels. I used to take trades at those levels, but I realize that our failure rate is more than 75% when it comes to those zones. I'm not a person who tries to reverse the market. You've got to learn this the right way, because at the end of the day, it's knowledge that leads to success in trading. You cannot become a successful trader without learning these basics. Market makers manipulate the markets mostly on these kinds of important levels. That is why you need to learn about them first. To become a winner in your trading journey, you must first put a full stop to your losing streak. Only then you can start making money consistently. And the first step to avoiding losses is proper education. We'll stop here for today. Remember to subscribe to the channel and leave a comment because I'll be covering every aspect you need to understand in order to become a successful trader. Mention what you want to learn in future. So stay connected. Good luck, everyone.